fundsupermart.com.
The recent market correction in China has taken many aback. How can investors stay afloat? Is there any opportunity in the fixed income world? Jamie Grant, head of Asian Fixed Income Hong Kong of First Day Investments, shares with us his views. What is your outlook on the Asian fixed income market, particularly investment-grade bonds, for the rest of the year? What opportunities do you see ahead?
Well, investment-grade bonds have had a very good year this year despite the volatility. And one could argue when comparing investment-grade bonds in Asia to investment-grade around the world that they've actually outperformed. The question is whether they can outperform in the back end of this year. And really China's outlook will have a big part to play in that. Generally speaking, in an environment where central banks are manipulating and having impact via monetary policy, that's not a bad environment for fixed income product. The issue will be that of growth. So whilst the growth remains as it's stated now, fixed income returns should be okay. However, if we see any more meaningful decline in the growth outlook in China, that could have implication for credit spreads.
Amid the recent volatility in global equities, how do you think investors should allocate bond investment?
Well, of course, I'm going to tell you, being a fixed income fund manager, that you should always allocate more to fixed income. But I think the case in point of the last few months shows that actually that is a very true statement. The volatility experience in Chinese equities, for example, has been extreme. And you compare that to the volatility in Chinese fixed income in US dollars, it's been nowhere near as great. So my argument would be, in an environment where you still want exposure to China or still want exposure to Asia in general, fixed income is a better place to be because the volatility isn't as great. Now, if you compare the asset allocation in Europe or the US, for example, to fixed income, to the asset allocation to fixed income in Asia, it's much smaller. So I would think there's probably an opportunity there to add more in your asset allocation to Asia fixed income.
Can you share with us your investment philosophy on Asian fixed income? What countries and sectors are you positive on?
Our philosophy is all about delivering repeatable returns in the best risk-adjusted manner. We see ourselves in terms of competing for assets, competing for people's investments, really competing against term deposits. Now, term deposits have reduced, if not no, volatility. So we're trying to get the right type of portfolio construction that delivers the returns without excessive volatility. And you do that through a number of ways, a bottom-up approach to credit analysis, picking the right credits, using fundamental credit research and state-of-the-art technology, and overlaying that with an extremely important risk management approach, which blends together that bottom-up approach with your top-down macro strategies. And we think, and as proven by our experience in the last month, our funds have performed quite well on a risk-adjusted basis. What we like in terms of sectors, well, we tend more to focus on countries and sectors in our approach to investing in fixed income. And right now our key overweights have been China and Hong Kong for some time. Now, without question, there's been volatility, as we all know, in China, but it's been manageable, and thanks to our approach to credit analysis, we've avoided the names with the most amount of noise and problems around them, and investment grade has held up very well.
A lot of Asian emerging market currencies have depreciated against the USD this year. Do you think the depreciation has affected your investment strategy?
Yes, it has, without question. If we were sitting here this time last year, in our US dollar funds, we had allocations to Asian currency denominated bonds like Indonesian rupiah, Malaysian ringgit, for example. We've reduced those significantly over the course of this year as there's been pressure on those currencies. We think that will continue, but what we're looking for in September is really to see that the Fed will or won't they raise rates, because if they do raise rates, that should give some certainty for the market for the remainder of the year and may present an opportunity for Asian currencies. Looking at China, for example, the unexpected devaluation really posed problems for us with our CNH investments, our offshore RMB. We've typically invested in offshore RMB in our Hong Kong dollar funds because you get more incremental yield. With the devaluation, we reviewed our strategy in terms of CNH and reduced that accordingly until we get certainty over what the policy is going to be for the currency